Welcome to this deep dive. Today we're cracking open a powerful source about mastering your money. Key insights pulls from Tony Robbins' book, Money Master the Game. Think of this material as, well, a concentrated guide. It's packed with wisdom from some of the world's top financial minds.
That's right.
Our mission is to unpack its core message, slice through the jargon, and really extract a clear blueprint, something you can actually use to take control of your financial life.
Yeah, because the world of money, investing, securing your future, it can feel incredibly overwhelming, full of conflicting advice and what feel like hidden traps. So we're going to explore the challenges this source identifies, why maybe traditional approaches aren't serving people well today, and importantly, what strategies the real masters use.
Absolutely. We'll look at everything from the sneaky ways our own brains work against us to the absolute necessity of fighting fees, building automated systems that work while you sleep, and even how legendary investors think about risk and opportunity. By the end, you should have a much clearer picture of how to start building your own path towards financial security and, well, beyond.
Okay, so let's jump right in by looking at the landscape this material describes. Why does mastering money feel so complicated for so many people?
Well, the source really starts by highlighting just how emotional and opinion-filled the world of money is.
Right.
It's compared to things like religion or politics. Everyone seems to have a tip, but often without, a proven track record.
Yeah.
It points out that there are a lot of experts who talks the talk, but haven't actually walks the walk when it comes to building real wealth themselves.
That really speaks to a core challenge. Information overload, and frankly, a lack of trust. The material notes that beliefs around money are super intense, especially you see it online. The crucial first step is learning how to separate those who have genuine results from those just promoting, well, unproven theories.
And there's a historical angle too, isn't there? The source mentions the whole concept of retirement as we know it.
Yeah.
It's relatively new.
That's a great point. Yeah, it's really only been a reality for maybe a generation or two. Before that, people generally just worked until they couldn't anymore.
Exactly. And today, the fears are very real for many. This material cites research showing the #1 fear for baby boomers was outliving their savings even more than death itself.
Wow. Yeah, and there's that stark statistic mentioned, a study suggesting 75% of Americans might expect their assets to, well, run out before they die.
75%.
And things like Social Security, while helpful, they aren't projected to be enough for a reasonable standard of living in most major cities globally.
So these common tools like 401ks are widespread. But this source gives a pretty strong warning. It says they can be bad, even disastrous, if you're stuck in the high-fee plans.
Which are unfortunately very common, yeah.
Right.
And it's not just the external system. Our own psychology is a massive factor. The material uses optical illusions as a great analogy.
I remember that part.
Yeah, showing how our intuition, which is usually helpful, can consistently trick us in predictable ways. If we make simple mistakes with something like vision, imagine how much more susceptible we are with complex financial decisions.
Makes sense.
Science is showing we're not always as in control of our decisions as we like to think.
This idea of complexity working against us is really key, isn't it?
Yeah.
The source gives that powerful example, the DMV organ donation forms.
Oh yeah, the opt-in versus opt-out.
Exactly. A seemingly small change in wording created enormous differences in participation rates. Why? Because, as the material puts it, nobody likes to check boxes.
It's true. Complexity is the absolute enemy of execution. If it's hard, we just don't do it.
Right. So the goal, according to this material, is to cut through that complexity, wake people up to these challenges, and provide knowledge and tools in a way that isn't too complicated, hard, or, time-intensive.
Okay, let's unpack how it proposes doing that then. It lays out this path described as a 7 simple steps blueprint.
7 steps.
Okay. The idea is to help you figure out exactly where you are financially right now, and then give you the tools to close the gap to where you want to be. It's framed as arming you for your financial life, starting today.
And it's not just theory, right? It's meant to be actionable.
Very much so. The material even mentions a free smartphone app associated with the book to guide you through the steps, track your progress, and offer support along the way.
Okay, let's look at some of those initial steps. Step 1 sounds like it's about getting your bearings. Psychology of wealth, deciding to be an owner.
Precisely. It explores what truly holds people back, making that fundamental decision to become a financial owner, not just a consumer. And right at the beginning, it introduces the almost magical power of compounding.
Compounding. The eighth wonder, supposedly.
It kind of is. Step one is fundamental. It's about activating a system by simply deciding on a percentage of your income, any amount, to start to save and invest before you spend it.
Automating it.
Yes, automating it is key. The miracle of compounding means your money starts working for you, building this automated money machine that generates income over time. It potentially allows you to become financially independent even if you never earn a massive salary.
The source gives some really inspiring examples of this, too, like Theodore Johnson, the UPS employee.
Yeah, amazing story. Never made more than $14,000 a year, but he consistently saved 20% of every paycheck and bonus into company stock and built significant wealth over his career.
20%, that's discipline.
It is. And think about Sir John Templeton. He invested a modest $10,000 during World War II into nearly bankrupt companies.
When everyone else was running scared.
Exactly. He had the foresight to understand that night is not forever, that financial winter is just a season. That investment exploded after the war.
Incredible. And it also mentions Chuck Feeney, the billionaire who gave most of it away.
Right. Lived incredibly, flew coach, wore a plastic watch, didn't own a car or home for much of his life. It really makes you think about what money truly means at the highest levels.
So the core takeaway for step one is earn more, spend less, and automate it.
That's the mantra. Simple, powerful. Think of that savings percentage not as a sacrifice, but as a crucial tax you get to pay to your future self and your family. Automating it just ensures it happens consistently.
Before you can miss it.
Exactly.
Okay, so once you've got that system activated, step two is framed as becoming the insider, knowing the rules before you play the game.
Precisely. This involves understanding and avoiding what the material calls marketing myths or, investment lies designed whether intentionally or not to separate you from your money.
And this is where it gets into the fees, right? The hidden costs.
Oh, yeah. This section really hits hard. It reveals that the headline fee, say 1% on a mutual fund, is often just one of over 10 potential fees lurking beneath the surface.
10 fees. Wow.
Yeah. And the stunning insight here is that an average mutual fund could potentially eat up a staggering 60%, 60, of your potential returns over time.
60%. That's unbelievable.
It is. Just grasping the concepts in this section, the source claims, could potentially save you hundreds of thousands of dollars over your lifetime. Minimum.
And it's backed by studies, not just opinion.
Right. It mentions other costs, like transaction costs, citing a 2006 study that found they averaged 1.44% per year for U.S. stock mutual funds, and these often aren't explicitly reported to you.
So you don't even know you're paying them.
Often, no. It highlights something called Myth 3. Our returns, what you see is what you get. According to the source, this is fundamentally false.
How so?
Well, the returns funds report aren't necessarily what investors actually receive, partly due to complex things like time-weighted versus dollar-weighted returns, basically. How the timing of money going in and out affects the real-world results for an individual.
Okay, that's getting technical, but the point is the advertised number isn't the whole story.
Not even close sometimes. The source using that analogy of a Charles Schwab lipstick on a pig ad from 2002 to show how numbers can be legally presented in, let's say, a flattering light.
This section also makes a really critical distinction. Brokers versus fiduciaries. Can you break that down?
This is huge. A broker typically works for a company and is not legally required to act in your best interests.
Not legally required.
Well, their business framework often rewards them for selling certain products that are profitable for the firm. Now, they might sincerely believe they're helping you, but their incentives can be seriously misaligned with yours.
Okay. So what's a fiduciary then?
A fiduciary is legally bound, that's the key, legally bound to act solely in your best interests.
Ah, okay. Big difference.
Massive.
Yeah.
The material stresses that aligning yourself with a fiduciary, specifically an independent registered investment advisor, or RIA, is perhaps the single most crucial step you can take here.
And how are they paid differently?
RIAs are usually compensated based on a percentage of the assets they manage for you, not commissions on products they sell. This helps ensure their advice is genuinely conflict-free.
Got it. So the source encourages you to ask your advisor directly, are you a fiduciary?
Absolutely. And it points out there are over 200 different financial advisor designations out there, many just window dressing, without that fiduciary duty. You need to find directories of fee-based advisors who are fiduciaries.
And this ties back to 401ks as well.
Definitely. You need to know the total cost in your 401k.
Yeah.
That's the fund fees plus the plan administration fees, which can average around 1.3% to 1.5% annually.
Which adds up significantly.
Hugely. As the source highlights, these combined costs can make a 401k surprisingly expensive, sometimes even more so than investing outside a retirement account in a taxable one.
Wow.
It provides tools and websites, personalfund.com, the fee checker on America's best 401k, to help you analyze your plan's specific costs. It even points out business owners actually have a legal responsibility to benchmark their 401k plans annually.
Good to know. Okay, so understand the rules, fight the fees.
Yeah.
Then step 3 is about making the game winnable for you.
Yeah.
Setting goals.
Exactly. Most people have this vague idea of wanting financial freedom, but they have no clue how much money they'll actually need to make that happen.
Guilty as charged, probably.
Most of us are. So the source provides a framework to define different levels: financial security, then financial independence, and finally, absolute financial freedom. Concrete targets.
And it helps you calculate the number, the critical mass.
Yeah, based on your desired annual expenses. A conservative estimate suggested is multiplying your desired annual expenses by 20. That assumes you can generate roughly a 5% return on that capital to live off.
Okay.
And the story of Ron is great here. He thought he needed $20 million, but doing this exercise showed he needed much less for security, like $2.7 million and maybe $7 million for independence. It makes the goal feel achievable.
Right, less daunting.
Much less. Turning those dreams into a concrete plan is crucial, and the source mentions using online tools or the app to customize it. It also hints at 5 specific ways you can potentially accelerate your progress if you find you're maybe falling short.
Okay, great. Now let's shift gears. Let's talk strategy. What do the world's top investors actually do differently? The source dives into insights from financial legends, right?
It does. And a foundational concept that comes up again and again is asset allocation.
Meaning how you divide your money between different types of investment.
Exactly. Stocks, bonds, real estate, etc. David Swensen, who famously grew Yale's endowment into a powerhouse, makes this striking claim. He argues that asset allocation explains more than 100% of investment returns.
Wait, back up. More than 100%. How does that work?
It sounds impossible, I know. But his point, echoed by others in the material, is that attempts at market timing, guessing when to buy and sell, and security selection, picking individual winners, often cost you money.
Through fees and mistakes.
Precisely. Fees, commissions, bad timing. So, starting with the right mix of investments across different asset classes is argued to be the most powerful driver of long-term success, outweighing the negative impact of trying to be too clever.
Okay, that makes more sense. So Swensen outlines 3 tools: allocation, timing, selection, and says focus on allocation.
Right. Asset allocation, most important. Market timing. Costly, often futile. Security selection. Also costly and very difficult. His approach emphasizes building a balanced portfolio mix across different types of assets.
And this leads to that practical concept highlighted: creating buckets.
Yeah, the buckets idea. A security or peace of mind bucket for the money you absolutely cannot afford to lose. And then a risk growth bucket for capital where you can take on more volatility for the potential of higher returns.
Makes intuitive sense. Does it give specifics for the security bucket?
It does, based on Swensen's approach. He recommends a significant chunk in U.S. Treasury bonds, splitting it between long-term bonds for deflation protection and TIPS, which protect against inflation.
Covering both bases.
Exactly. Plus, adding diversified global stocks and real estate investments like REITs, those companies that own income-producing real estate.
And there's a specific allocation mentioned.
Yes. The source highlights his specific mix: 30% long-term treasuries, 15% TIPS, 15% U.S. stocks, 15% developed market stocks, 15% emerging market stocks, and 10% real estate.
And the key is, this isn't just theory. It performed well historically.
Extremely well, according to the data presented. Significantly outperformed the S&P 500 over many years, especially during downturns. Remember those numbers. During the 2002 crash, it lost only about 4.5%, while the S&P lost nearly 50%.
Huge difference.
And in 2008, it lost 31% versus the S&P's 37%. It's designed to be more robust, protecting against both inflation and deflation. A smoother ride.
Okay. And the risk growth bucket, what goes in there?
That's where you might put individual stocks, ETFs, perhaps some high yield or junk bonds, maybe more real estate. But the warning is clear. Don't fall for "this time is different."
Markets revert to the mean.
They do. And you absolutely can lose everything in this bucket if you don't have protective measures or the right allocation overall.
Got it. Another strategy discussed is creating guaranteed lifetime income, especially important now we're living longer. It talks about annuities.
Yeah, annuities is a form of private pension. Now, this is tricky territory. Many variable annuities are pointed out as having high fees, being commission darling products.
Things brokers might push.
Potentially, yes. But the material highlights insights from experts like Dr. David Bogle, who advises the U.S. Treasury. He apparently used a series of guaranteed income annuities for part of his own retirement to lock in income, deliberately avoiding market swings in 2000 and 2008.
So it's not saying all annuities are bad, but some specific types might be useful.
That's the idea. The goal is to find the select, safe, affordable types that some experts apparently call a holy grail for retirement income. They can offer guaranteed income for life, maybe principal protection, potentially even allowing some growth within that secure framework.
Interesting. Okay, then there's a section on invest, like the 0.001%, pulling back the curtain on billionaires.
Yeah, this is fascinating. Insights from legends like Carl Icahn, Ray Dalio, Paul Tudor Jones, Jack Bogle, Charles Schwab, Sir John Templeton again, J. Kyle Bass, Mark Faber.
Go out a list. What are some highlights? Icahn?
Carl Icahn, the activist investor, sometimes called the most feared man on Wall Street. Incredible compounded return mention, 31% from 68 to 2013, even beating Buffett. His focus, corporate governance, holding management accountable to shareholders.
Okay. And Ray Dalio, the all-weather strategy.
Dalio's approach is brilliant in its concept. The all-weather portfolio is specifically designed to perform reasonably well no matter what the economy is doing: inflation, deflation, growth, recession.
How did it do historically?
The back testing showed impressive results. Nearly 10% annualized returns after fees from 84 to 2013, made money 86% of the time, and crucially, had tiny losses in bad years, like only down 3.93% in 2008 when the market crashed.
Wow. So it's about consistency, not massive gains.
Exactly. A smooth ride, consistent protected growth, not flashy but effective.
And Paul Tudor Jones, the guy with 28 winning years straight.
Incredible record. He shares his core risk metric, the 200-day moving average. If an asset drops below it, he gets out. Period. Protect capital first.
Simple but powerful.
He says the whole trick is, how do I keep from losing everything? And he believes you only need to be right maybe 1 out of 5 times if your risk control is that good. Such a different perspective.
Totally. And Jack Bogle, founder of Vanguard.
Bogle is hailed as a hero for the individual investor. He pioneered low-cost index funds. His core idea, investors as a group re the market, trying to beat it consistently, especially after high fees, is mostly a losing game.
Fees again.
Always fees. He shows how just 2% in annual fees can destroy your long-term returns, turning $30 into just $10 over 50 years.
And Buffett endorses this strategy.
He does. For his own family trust, he recommends 10% short-term bonds and 90% in a low-cost S&P 500 index fund. He predicts it'll beat most high-fee managers. He even made that million-dollar bet that hedge funds couldn't beat the S&P over 10 years.
He won that bet, didn't he?
He did.
What about Kyle Bass, the housing bubble guy?
Bass looks for riskless return, or asymmetric bets, small risk, huge potential reward, like buying nickels when the metal was worth more than 5 cents. He also noted how unprepared Wall Street was for housing prices not rising in 2006.
And Mark Faber, Dr. Doom.
Faber is the contrarian buy when there's blood in the streets. Looks to Asia, critical of money printing, likes gold as a hedge, thinks high-end real estate is bubbly.
A common thread among these masters seems to be contribution, giving back.
Yes, that comes through strongly. The source emphasizes that true, lasting meaning often comes from giving, not just getting. It highlights that Churchill quote, "We make a living by what we get. We make a life by what we give." Many of these titans are also huge philanthropists.
Powerful. Okay, beyond investment strategy, how does the material suggest accelerating your path?
Well, compounding comes up again. Start early if you can, but it works at any age. The key is starting.
And automation is huge here too.
Absolutely critical. Automate your savings. That Save More Tomorrow plan is mentioned. Commit a percentage of future raises automatically. You don't miss what you never got used to having.
Smart. And finding savings isn't just about fees.
Right. Look at big expenses. Cars, housing, but also smaller leaks, impulse buys, daily habits. The example of Angela saving $400 a month just by trading her car, that adds up.
It really does.
The idea is a spending plan for joy and freedom, not a restrictive budget. And the promise is there are real, meaningful savings, potentially hundreds of thousands or millions over time available to find and reinvest.
Ultimately, though, the source says the biggest obstacle is us, a mindset.
Our stories, limitations, fears. It boils success or failure down to 3 things: your state, your emotions, mindset, your story, your core beliefs, and your strategy, the actual plan.
State, story, strategy.
Right. And true transformation, it argues, happens in a moment when you decide, draw a line, set a new standard. Strategies are useless if you're in a lousy state or have a limiting story.
Like the example of Julie, who thought money was evil.
Exactly. Despite her success, that belief held her back financially. Our internal story dictates so much.
So it comes back to investing in yourself.
Constantly. It references Jim Rohn. Focus on what you can control, improving yourself, serving, adding value. That relentless focus on contribution and getting better is presented as the pathway.
The source also touches on technology, right? Both the threat and the opportunity.
Yeah, it acknowledges the disruption nearly half of U.S. jobs potentially automatable, but it frames technology primarily as a resource-liberating mechanism.
Like the ladder and the orange tree analogy.
Exactly. It helps solve scarcity. Think clean water tech like the slingshot, or food tech like vertical farming, even in vitro meat.
So technology could actually make a great life cheaper in the future.
That's the potential. Decreasing costs, expanding capacity. It empowers individuals too, like the kid who designed and shared a robotic hand open source. Anyone with internet can be a creator now.
Finally, what about money and happiness? Can it buy it?
Well, the old saying is no, but recent studies cited suggest money can increase happiness, but it's how you spend it. Even small amounts, like $5 a day spent on others or experiences, can make a difference.
Interesting. And the reminder about not being the richest person in the graveyard.
Crucial point. That image of the physically suffering billionaire at Cirque du Soleil. Wealth is pointless if you haven't mastered health, relationships, purpose. You need the whole picture to enjoy it.
So cultivating gratitude is important.
Hugely important. Presented as a powerful daily practice, even just 10 minutes to help eliminate negative states like anger and fear, it fundamentally improves your state.
And it all circles back to contribution.
Seems to be the ultimate message. Adding value for others brings abundance, not just financially, but in life. The more you give, the more life gives you.
Wow. We have covered a lot of ground in this deep dive.
We really have.
From, understanding the traps in the system in our own minds to embracing simple principles like compounding and automation.
Exploring strategic allocation like Dalio's all-weather or Swenson's approach. Learning why fighting fees like Bogle is absolutely non-negotiable.
And ultimately realizing the critical role of your own mindset, your story, and that focus on contribution.
Yeah, this material provides a really comprehensive look, a blueprint filled with powerful strategies and genuinely inspiring examples from people who have truly mastered the game.
It's a strong call to action, isn't it? Take control, simplify, automate.
Focus on what truly matters. It really challenges you to think about the conventional wisdom we often just accept about money and investing.
And ask, is it really serving me? Or is it holding me back?
Exactly. It pushes you to look beyond the surface, to the underlying systems, the biases, the proven principles that actually work.
So here's a final thought then, for you to consider as you reflect on all this. If gaining financial freedom can empower you to make a greater contribution, and if true meaning comes from what you give, what is the one small automated financial step you could commit to taking today, right now, to start building the abundance needed for you to live a life of even greater giving tomorrow?